Partnership accounting. In India, partnership is governed by the Indian Partnership Act 1932. Section 4 of this Act defines partnership as the relationship between persons who have agreed to share the profit of the business carried on by all or any of them acting for all. Essential features of partnership: an association of two or more persons, an agreement entered into by all persons concerned, existence of a business, the carrying on of such business by all or any one of them acting for all, and sharing of profits of the business, including losses, unlimited liability of all partners.
What is firm?
The persons who enter into a partnership are individually called partners and the business is called a firm.
Is registration of partnership firm is not necessary?
Registration of partnership firm is not necessary, but an unregistered firm can't take any legal proceedings against any person.
How partnership business becomes illegal?
There should be two or more persons to form a partnership, but the numbers of partners should not exceed 20. In case of banking business, it must not exceed 10. If the above limit exceeds, the partnership business becomes a legal business.
Is liability of partners is unlimited?
The liability of partners is unlimited. If the assets of the firm is not sufficient to pay liability, then partners have to fulfill it from their personal assets.
Are partnership firms separate entities?
As per law, partners and firm are not separate entities. Partnership deed. A partnership is run by a mutual written agreement called partnership deed. The deed generally deals out the following clauses: name of the firm and nature of partnership business, commencement and duration of business, amount of capital to be contributed by each partner, amount to be allowed to each partner as drawings and period allowed and interest, if any, on such drawings. Rate of interest to be allowed to each partner on his capital and on his loan to the firm, and to be charged on his drawings. The ratio in which profits or losses are to be shared. Whether a partner will be allowed to draw any salary. Any variations in the mutual rights and duties of partners. Method of valuing goodwill on the occasions of changes in the constitution of the firm. Procedure by which a partner may retire and the method of payment of his dues. Basis of the determination of the executors of a deceased partner and the method of payment. Treatment of losses arising out of the insolvency of a partner. Procedure to be allowed for settlement of disputes among partners. Preparation of accounts and their audit. Kinds of partners. General partners. Each partner is personally liable if the other partner fails to meet their obligation under the agreement. Limited partners. Partners may have limited liability to the extent of their respective capital contribution. Please note, limited partners can take part in the management and the control activity of business. Every limited partnership must have at least one general partner. Active or ordinary partner, who take active part in the conduct of business. Sleeping, dormant or silent partners, who do not take part in the conduct of business, that is, only contributes capital. Nominal or ostensible partners, who do not contribute any capital and without having any interest in the business, lend their name to the business. Minor partners, who has not attained the age of majority, is called a minor partner.
Minor can be admitted into partnership?
Yes, a minor partner can be admitted only for the benefits of the partnership.
Minor is personally liable for debts?
No, a minor partner is not personally liable like other partners for any debts of the firm. Partner in profit, who is entitled to the profit of the business without making himself responsible for losses, is called a partner in profit only. Subpartner, a partner may enter into a contract with a third party, an outsider, to share his profit. In such a case, the third party is called a subpartner. Holding out partners, Section 28 of the Partnership Act 1932. A partner who represent himself or allow himself to be represented as a partner is said to be holding out as a partner under the principle of estoppel. To register a firm, a statement in the prescribed form must be sent to the registrar of firm of the area. The statement must contain the firm name, the principal place of business, the name of its other place of business, the date of joining of each partner, full name and address of partners, the duration of the firm. Powers of partners. A partnership firm have to give a public notice before entering into a contract. A partner can act without consulting other partners. In case of trading firm, the implied power of partners are as following: buying and selling of goods, receiving payments on behalf of the firm and giving a valid receipts, drawing checks and drawing, accepting and endorsing bill of exchange and promissory notes in the name of the firm, borrowing money on behalf of the firm with or without pledging the stock in trade, engaging servant for the business of the firm.
Individual partners has no power to bind the firm, or third parties can't bind the firm unless all the partners have agreed.
Following cases are: 1. Submitting the dispute relating to the firm arbitration. 2. Opening a bank account on behalf of the firm in the name of partners. 3. Compromise or relinquishment of any claim or portion of claim by the firm. 4. Withdrawal of a suit or proceeding filed on behalf of the firm. 5. Admission of any liability in a suit or proceeding against the firm. 6. Acquisition of immovable property belonging to the firm. 7. Entering into the partnership on behalf of the firm. As per Section 13, in the absence of any agreement to the contrary, no partner has the right to a salary. No interest to be allowed on capital. Interest at the rate 6% is to be allowed on partner's loan. No interest is to be charged on the drawings. Profits or losses are to be shared equally. Please note, in the absence of any agreement, the interest and salary payable to a partner will be paid only if there is profit. Partners' capital accounts are made under two methods. 1. Fixed capital method, and 2. Fluctuating capital method. Under fixed capital method, two accounts are opened: partner's capital account and partner's current account. Partner's capital account. 1. Only initial capital contribution by partners are credited. 2. This account is only changed when there is change in the constitution or when partners draw money from business. Partner's current account. Asterisk, all transaction except partner's capital and drawings are recorded like salary, interest on capital, interest on drawings, etc. Fluctuating capital method. No current account is maintained. Capital account balance of the partners fluctuates every time. All the entries regarding partners' drawings, salary, interest and share of profit are passes through the capital account.